Another broadcast. I'm looking forward to this. It beats cutting the grass. We about a year and a half ago, we bought a farm here in Alabama, and there's about 14 acres of grass. And so, needless to say, in the summertime, that's a lot of grass to cut. So I cut about 4 acres today. I had to wait for it to cool down a little bit because it was really smoking hot today. But we're getting there. We're getting there one step at a time. I will say that at the end of the broadcast last week, I said I was going to be in at the beach this week. Well, I lied. It was the week after. So the beach is next week. This week is cutting pasture and getting ready to go to the beach. But while I'm doing that, I thought I'd just spend some time with you guys. I mean, what better evening could we have together than talking about dividend stocks, right? So let's see who's here. And what I want to talk about tonight are what are my favorite dividend growth stocks. There's some dividend growth stocks that I really like, and I thought I'd share those with you. So let's see who's in the program tonight. We got Steve C. Steve says, please look at STLA tonight. I think that's Stellantis. It's an A on Schwab and 5 stars on Morningstar. It has an 8% yield, which is pretty good for a non-tobacco stock. I don't own any yet. Thanks. Yeah, we'll do that, Steve. We'll. I don't have a place to. Yeah, I do. Hold on. I'm going to put that on my list here so that I don't forget to look at it. So just bear with me for a second. STLA. All right, we got it. We got it on the list, my friend. Thanks for pointing that out. We'll take a look. Rust Moments says he likes the new name. Thanks, man. I appreciate that. John Jay's in the house. He says Chipotle, a 50-for-1 stock split is coming. Here's what investors need to know. Wow. I didn't realize there was a 50-for-1 split on Chipotle. That's pretty impressive. And maybe we can talk a little bit later about stock splits and why companies are doing them. I really don't get it, to be honest with you, but maybe we can talk through that. What do you think? Maybe you could throw some comments in there for me. What do you think are some reasons that companies will split their stock? So Pat is in the house. Good evening to you, my friend. Oh, so Rust is wanting to know, actually, it's shaping. I don't know. It used to be shaping. Now it's Rust Moment. So I'm going to call you Rust. Is that okay? Do I own EOG? And the answer is yes, I own EOG. And it did very well today, or at least it did early on. I didn't look at it later in the day, but early on, it was doing very well. Steve C says, hola everyone. Kevin Mendoza is in the house. That means we have a quorum of Kevins, and therefore we can get started. Let me see if there's anybody else. El Dynamico is in the house. How am I doing? I'm doing great, man. I am doing so well. The market was really smoking hot this morning, and it was really looking really nice. And then it kind of cooled off. In the day, and so I ended up about 0.3% up, which is, I don't know, $4,000 or $5,000 for the portfolio, which is nothing to be sorry about. So that'll pay for the beach week, right? Greg's in the house. So good to see you, my friend. And yes, we can call him Rust. So let's call him Rust. So that's good. Jim Betts made it. I'm glad you're here, my friend. And before we move on, Kevin Mendoza says that he bought some of his favorite stocks today: AT&T, 3M, US Bank, and Altria Group. So well done, my friend. Those are some solid dividend stocks. Gant is in the house. I think if a company does a stock split, I'll pick this up in a little bit. We'll have that be part of the discussion tonight, but I want to go ahead and start laying out some of the my favorite dividend growth stocks. Now, these are not necessarily the highest yielding stocks, right? Because I have labeled them as dividend growth stocks. And so maybe I can share some of the difference, right? So for me, in my portfolio, I have stocks that are kind of labeled as dividend income stocks, which I look for higher yielding stocks, but I still want the companies to be growing. I realize they're going to be growing a lot slower, but I don't want them to be falling off. I don't want them to be trailing off and then paying an increasing dividend. That's not a good combination for the long run. So I call those dividend income stocks. Dividend growth stocks are the companies that maybe they don't have the highest yield. Actually, they would have maybe a very low yield, but their growth is consistent and predictable, and their business is building that growth. So that's and then I also have a category that I call value stocks, and those are the stocks that are trading well below their intrinsic value. They may be bringing something else to the table, like for instance US Bank. I consider it a value stock, but because it is so undervalued, it's got a pretty high dividend yield. So if you look at it in my portfolio, it's either a value or income, but it's actually both. And so anyway, that's kind of the way I look at it. So when I talk about dividend growth stocks, I'm talking about stocks that are going to grow like crazy their dividends and be consistent and dependable in that growth. So let's go ahead and get this thing rolling here. I need to share a screen. So I will do that. Don't mind me. Nothing to see here. There we go. I'm going to take Gant's thing off the screen. I'm going to move on over to my friends here. Oh, there's one of them already. I'll wait for that one. I'll go in alphabetical order. How does that sound? So we'll go back to here. One of my favorite dividend growth stocks is, and then this may be surprising to some of you, is Air Products and Chemicals. Why is that? It's a dividend yield of 2.61%. Its dividend growth in 2024 was only 1.1%. So that's why I say it might be surprising, because in 2024, they grew their dividend by only 1%. But if you go and you look at the performance of the company, you look at their balance sheet, and you look at why the CEO said that the board decided to only grow the dividend by 1%, I think it makes perfect sense. The stock had plummeted in value, and it had a high yield at the time. So his point was, there's a high enough yield already in the stock there to pay more dividend doesn't make sense. So they did raise it to keep their streak alive, but they only raised it by 1%. I'm okay with that. They can take that money and invest it in their plants, and that's what they're doing. And so I think that was actually a very good move. If we see their stock price kind of stay up, I'm expecting they'll keep their trend, which, if we look at the 5-year dividend CAGR, dividend growth, it's double digit, 10%. So even with one of those 5 years being 1%, their average for the 5 years is 10%. They're very consistent. Take a look at that chart right there. They are very consistent in their growth of their dividend. I really like the Air Products company as a dividend growth company. I bought a lot of it. It's one of the highest, maybe, I don't know. I guess it is the highest. Here, let's look. No, it's second. It's second to Johnson & Johnson. So it is the number 2 stock holding in my portfolio. I do have VU, which is S&P 500, which is a lot higher, but that doesn't really count. So anyway, okay, Air Products and Chemicals, that's number 1. Let's go to the second one. And I didn't write these in alphabetical order, so I'm having to do that in my head here. Our next one, and maybe this might be interesting to folks as well, is Hess Midstream. Now you take a look at Hess Midstream, and it's got an unsafe dividend safety rating, and then you go, well, how can that be one of your favorite stocks, the dividend growth stocks, especially when it's yielding 7.1%? How does this make sense? Why am I even listening to this live stream? This makes absolutely no sense. Well, let's go down and take a look at the data itself, and then I'll tell you why I think they've rated it as an unsafe. So they've been around since 2016. You can see that they spun off from Hess Petroleum in 2016. These are their midstream assets somewhere in the Bakken region, up in like Minnesota, South Dakota, North Dakota, in that area. So you can see that their dividend has grown pretty consistently over that 6-year period. And when I look at the 5-year dividend growth, it is growing by 12%. It's growing more than Air Products and Chemicals. So when I look at the last year, it was a 9% dividend growth. Now, they raise their dividend pretty much every quarter. So every quarter, you're getting a little, maybe a 2% raise or something like that. But over a full year, that's a nice dividend growth over time. So why do I believe that they have a 40 for a dividend safety? I believe it is because they basically have one customer. That customer is Hess Petroleum. And some of you will recall that Hess Petroleum is in the process of being acquired by Chevron. So, they're kind of a captive customer. They're a captive supplier to Hess, soon to be Chevron. I think that's why it is. But to mitigate that risk, they have some really good contracts in place. They have not only contracts for volume but for price. So I think they're going to be in pretty good shape, at least for the next 3 years, because that's the length of their contracts. So we keep an eye on that. If their contracts begin to, not be 3 years anymore, and they're not able to roll these great deals in these contracts, then I might reconsider. But for right now, I'm pretty good. I've got like 1,000 shares of Hess Midstream, and been very happy with that over time. So it's one of my favorites. The next one is, drum roll, Hershey. Hershey is one of my favorite dividend growth stocks. Why is that? Well, let's flip down here and take a look at the chart. Look at those dividends. They have a streak of 94 years of paying a dividend. They've got a growth streak of 14 years. So it looks like somewhere back in here, maybe 08, 09, they did not raise their dividend. I don't know how long before that they raised it, but looks like from 08 to 09, which happened to be the great financial crisis. So that kind of makes sense. But it's really a shame that they didn't raise it a little bit just to keep their streak alive. But anyway, 14 years, that's nothing too shabby. But if you look at a 5-year growth, it's 10%, double digits, just like Air Products. And if you look at the last year, it rose by 15%. So they are growing their dividend, and I am really enjoying owning Hershey. So who's my next one? Let's see. A, B, C, D, E, F, G. I got to do my alphabet here. I think the next one is going to be NextEra Energy. Now, NextEra Energy has risen quite a bit here over the last few weeks. I bought it a couple of months ago, and I'm already up like 24% on the stock. So not saying that now's the right time to buy. It might be. I don't know. But it's a pretty small percentage of the portfolio. It's actually one of my smallest holdings. I was planning to buy more, but it ran up so fast. Right now it's 1.2%. But so why is it one of my favorite? First of all, it's a 90, very safe rating. And so if I look down here, I've got a 5-year CAGR of 11%. So it's higher than even some of the others. And look at that line. I mean, it is since 2000 and let's say 15, it has been, going up like crazy. One of the things I like to do, just for if you guys I won't charge you anything for this, but one way to tell whether the business is growing at a pace that'll pay for the dividend. So this is something really cool. If you want to add this to your arsenal, and many of you will already know this, but if you don't, it's worth the price of admission. So you see this dividend going up. Well, if the business is not generating the profits to be able to pay that, that will show up in the payout ratio. So if the earnings are flat and the dividends are going up, your payout ratio is going to go higher and higher. So take a look here at NextEra. You see that the dividends are going way up, but let's take a look at the payout ratio. The earnings payout ratio is pretty flat. I mean, look at that, from 59, 60, 61, in the next 12 months is 60%. So what that means is the business is growing at a pace to match what they're increasing their dividend by. That's a very great story to have. Also, for those of you who care, free cash flow payout ratio is not a good metric to use for utilities. I don't want to go into that right now because it's a little complicated, but utilities use their capital to grow their earnings. And so, they will grow their earnings. Sometimes they will borrow money, and sometimes they will go out and get equity, but they are usually investing way more than their current cash flow, and that is because they are looking for that growth. The way they grow their earnings is to increase their rate base, which is basically the assets that they buy. So to grow, they gotta grow. They gotta spend money, and so free cash flow payout ratio is not a good metric for utilities. Earnings payout ratio is much better, in my opinion. All right, so there's NextEra Energy. So my next one, there's a total of 6, and we are on number 5. And I'm going to pull that up now as I do the alphabet in my head. Let me do this. We're going to go to Parker Hannifin. It is one of my favorite dividend growth stocks. It's only a yield of 1.28%, but it's a very safe rating of 94. Let's take a look at, look at the gain on this, 58%. That's awesome. And let's take a look at this. A 5-year dividend CAGR of 15%. That means that on average, the dividend has grown by 15% per year. That is amazing. If you think about keeping track of or keeping pace with inflation, if inflation is 4%, 3%, 4%, it was 9 at one point. If it's about, good, you guys aren't seeing that. I got a message about Windows Defender or something. But, so 15% is, if we're talking about inflation being 3%, 15% is 5 times the rate of inflation. So these guys are knocking it out of the park. Take a look at this chart. Especially the last couple of years, has just grown tremendously. So Parker Hannifin, that is number 7. And the last one, which happened to be the one I had pulled up when we came online, is United Healthcare. Look at this dividend safety rating of 99. So a dividend yield of 1.71%. If I go down then and take a look at the growth, I see their 5-year CAGR at 16%. That is amazing. So again, that can be 5 times the rate of inflation. And their latest was 12%. Nothing to be sad about there. Oh wow, the last 20 years has 41%. So wow, that's amazing. 41%. But I like to look at the last 5 years because it's what did you do for me lately, and the lately is 5 years for me. So there you go. Those are my 6 favorite dividend growth stocks. And again, by definition, I'm not looking at my dividend yield stocks, which are income stocks, and I'm not looking at my value stocks. I'm looking at what I consider to be my dividend growth stocks. So there you go. Let's take a look really quick at STLA. I think Craig is wanting to see that. So that's Stellantis NV, whatever that means. It's a consumer discretionary. I'm not familiar with it, so let's take a look. It's in the automobile manufacturers. It has a dividend yield of 5.97%. It has foreign taxes withheld. We'll see here if it says which country it is, and it does not. So we'll look here. It engages in design, engineering, manufacturing, distribution, and sale of automobiles and light commercial vehicles, yada, yada, yada. Alfa Romeo, Chrysler. These are its customers. Peugeot. I haven't heard that name in a while. Oh, and it's based in the Netherlands. So there you go. I don't know what the tax rate is in the Netherlands, but if we can actually use Simply Safe Dividends to find that out. Well, there we go. Netherlands is 15%. So if you buy this outside of your tax deferred accounts, so if it's like in a after tax account, there would be a 15% dividend tax. You could get that back on your tax return, so it's nothing to be really alarmed about. But it's just a complication that I'm not interested in from a tax perspective. So I typically don't invest in foreign companies unless it's in my tax deferred accounts, like my IRA or my traditional IRA or my Roth, one of those two. All right, so 5.97% dividend yield. They wow, look at this dividend. It has jumped all over the board. That worries me a bit. So let's do this. I don't know if you said Morningstar covered that. So let's go to Morningstar and take a look at STLA. Stellantis. You're correct. It is a 5-star. And let's see what their fair value is. Fair value is $38. So if I were to buy this, look at that, 46% discount. And I'm not saying I would buy it, but if I were to buy it, I would consider this a value stock. I wouldn't consider it necessarily a dividend growth stock or an income stock, even though it might fit all three of those categories. So take a look at this. 5.97% yield is a high yield. That could be an income stock, right? The dividend growth, 15% over a 5-year period, growing very fast, could be a dividend growth stock, right? But with the fluctuation in the dividend, so probably this is a 20-year period. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So out of these 20 years, they paid dividends in 11 of them. So that has me a little bit, I don't know, worried. So if you're okay with fluctuating dividends, and I mean, not necessarily fluctuating, but having a dividend or not having a dividend, if you're okay having a year like 08, 09, no dividends, 10 having a dividend, 11 through 15, no dividend, 16 through 18, a dividend, 19, 20, no dividend. If you're okay with that kind of volatility in your dividends, then it might be worth taking a look at. That is not something that I want to see in my portfolio. But again, I'm retired, so my situation might be different than yours. But so it doesn't mean it's a bad stock. It just means that for me and my portfolio, it wouldn't be something that I'm interested in. So hopefully that's helpful. Craig, I just giving my honest opinion. And I think that's what you want, right? So that's why you're here. All right. So we took care of STLA. And I think let's deal with this next question, and that came from my buddy John J. So John's question is around. It's not really a question. It's about, I didn't pull the right one up, but where is it at? Chipotle, 50-1 stock split. So why would companies do a stock split? And let me see what you guys say about that. I saw some comments in here. Here we go. Gant has said, I think if a company does a stock split, will make it easier for us to own their stock if the broker doesn't offer fractional shares. Yes, that is a very good point. If it's, trading at a very high price and your brokerage doesn't allow fractional shares, absolutely, totally agree, 100%. Let's see. Stock splits make options contracts way cheaper. That is true, because in an options contract, for those of you who don't trade options, an option contract is really 100 shares. So you have to, let's say you're doing a cash covered put, which means that you're saying, I will buy shares if they go down to a certain level. If you're doing that, you have to put up collateral with your brokerage for 100 shares of that stock for every options contract that you buy. So what does that mean? If your stock is $400, you got to put $40,000 down. If your stock is $40, then you only have to put down $4,000. So it's a big deal. So that is a good reason to do splits. So let's I'm not sure that I can remember all these. These are all good ones. Yeah, if your brokerage doesn't offer fractional shares, about stock splits. What else? Let's see. Oh, Honeybee has arrived. Thanks for showing up, my friend. Good to see you. Let's see here. Jim says he actually sold his NEE position and moved it to ATO, slimming the portfolio down yet more. I now have 33 holdings. You know what, Jim? I think that's not a bad move. I own both. I own both NEE as well as ATO. As a matter of fact, ATO was on my list, but for favorites tonight, but they just didn't make the cut when it came to the 5-year dividend CAGR. So I removed them from the list. I think I only had 8 to start with. Ended up being 6. But ATO is, for those of you who don't know, is Atmos Energy. It's a gas company out of Texas. And I think they're going to do very well. They're going to be very consistent. And I am looking to, well, let's do this. You want to see it? You want to see it in my portfolio? Because I can't remember everything. That happens with age. So it's basically 2.4% of my portfolio. It has a very low payout ratio for utilities, which is 46%. I mean, you saw NEE, which was around 60%. So ATO looks good. My shares are about, up by 24%. I've owned them for a long time, though, but I buy them, periodically. Let's see. Let's take a look. They got a 97, a very safe dividend rating. And my sister convinced me that I needed to drink more water. So I've got a little water jug here. And I'm going to take a drink every now and then. So just to stay hydrated for you guys. Actually, it's for me, but so yeah, 97, very safe, 2.73% dividend yield. Let's take a look. We talked about what they do. So here's their dividend growth. They grow at 9% a year. Look, last year was 8.8, very consistent. Look at this chart. Here recently, they've really begun to grow that. So if you look at their 20 years, it's only a 5%. It's because the charts is not as steep back a few years ago. So they're doing very well. I like Atmos Energy. So, Jim, I don't think that's a bad move at all. NEE has grown in value so fast that it might not be a bad move to kind of take those gains off the table and move it on to something else. I don't know. I think I'll hold it for now, but that's not a bad move, my friend. All right, where are we at here? I went off on a tangent. That never happens, right? All right, El Dynamico, he says, I think Altria Group is raising its dividend within the next few months. I'm not really sure. So, full disclosure, I sold off my Altria. Um, as you guys know, I had a pretty big tax bill back in April. So I liquidated probably like 80 or $90,000 out of my portfolio. Yeah, I know it's bad. And so I needed to get some shares that were, readily available. So Altria was put on the tax payment altar. So I don't own Altria anymore. But so let's take a look at whether they're going to release a higher dividend. Yeah, I think you're right. You're right, El Dynamico. They've declared a 98-cent per share dividend in July, but when they declare for September, if they are going to stay true to their pattern, which is to increase it every 4 quarters, then they've got 4 quarters here of 98 cents. So you would expect them to grow that again by some number. Looks like in 2022 they grew it by 4 cents, and then 2023 they grew it by 4 cents. What do you bet they do 4 cents again in 2025? Maybe we could do a bet on that. 4 cents sounds reasonable to me. What do you guys think? You think they'll go 4%, but will they go less or more? You don't have to tell me how much, but do you believe 4% or 4 cents? I mean, 4 cents, which is about 4%. So do you believe 4 cents, or do you think lower, or do you think higher for Altria? What do you think their dividend is going to do? So let's see here. Kevin Mendoza owns Air Products, which he says I really like, but I also want to buy LIN, which is Linde, LINDE. That's the name of the company. I think I'm pronouncing it right. It may be redundant, but I think I'm going to do it. What do you think? First of all, I think Linde's a great company. I think they may be a skosh overvalued. Let's take a look at that just to kind of give you that perspective. So Linde. Well, they're not. They're no. It's in fair value range, so I don't have any issues with that at all. Linde is a great company. Let's take a look at some of their stats here. They are actually they're better, I think, in terms of the balance sheet than Air Products. They have a 99 safety rating, 1.25% yield. Let's take a look at their growth, 9%. So they're roughly the same in terms of dividend growth as we saw in Air Products. So, but I think they've got a safer dividend, and who knows what their growth is going to be in the future, but I think it's going to be very good. So I think owning both of them is not a bad way to go. And you might even think about it in your portfolio. If you're concerned about, double dipping there, you might consider them to be the same stock so that, from a diversification perspective, maybe this is not going to make sense, but you've got 2 stocks in the same category. They're both materials, or both industrial gases. So maybe you can, if you don't want to be exposed too much to the industrial gas area, maybe you say, I'm going to, say, I don't know, 5% total, and you have some of it in Air Products and some of it in LIN, and but don't go above 5% for both or something like that. I think that's a great way to go. But yeah, Linde is a great company. No issues whatsoever with them. Oh man, I don't have that on the screen. Anyway, there you go. Linde is a 99, and you can see the growth rate is 9% over a 5-year period. So just so I didn't cheat you out of those charts. And then here is the fair value from Morningstar. They say fair value is around 420. It's trading around 442. So it's just a skosh above fair value. But here's what I'll say about fair value is nobody really knows, but we try to get close, right? And so if it's, a few percent off, it's not, not the end of the world. So it's definitely, worth doing. If that's what you want to do, if you got conviction in Linde, I would do it, man. I got no issues with that whatsoever. Okay. Let's go back to this. All right. Jim Betts says he had owned Stellantis, but the once a year dividend payout, and I didn't catch that. The once a year payout was a bummer. So yeah, that would be a bummer to me too. But that's just me. Chris, also known as Kamarai, is in the house. Welcome, my friend. Good to have you on the program tonight, and we are glad you made it. Michael Swami, we talked about some utilities earlier. I didn't think you were on here. I didn't want to go through it without you, but we did it anyway. I think we muddled through, but it's good to have you here, my friend. His alarm clock didn't ring, so we may have to pitch in and buy Michael a new alarm clock. So SCHD Stan, it is great to see you, my friend. Good job, man. So any thoughts on PLD? Well, I don't know. Let me even see what PLD is. So first, since I've got this Morningstar pulled up, PLD is Prologis. Yeah, I knew that. I don't know why I was brain farting there, but so Prologis is it's a fair value of 120. Price is running around 111. So I guess it would be considered fair value, but this is skosh maybe undervalued. So that's not so bad. Now let's take a look at PLDs. I don't follow them, so they've got a 61 safe dividend rating, which is not too bad. 3.44% yield. Let's see. Nothing cool there. So the last 5 years of dividends, they have grown by 13%. Their latest was 10%, so you can't hardly beat that. It looks like during the great financial crisis, they struggled. But since then, they have really come on. They've got a 10-year dividend growth streak, so that's good. Let's look at some of their metrics. Looks like their payout ratio is increasing, so that might be something to take a look at. So remember I mentioned earlier, and we'll go back here. So when the dividend goes up, like it's doing 22 to 23 here, when the dividend goes up, if the earnings aren't going up at the same percentage, then the payout ratio is going to bump up. And that's what we're seeing here. So I'm not really sure what's going on in the next 12 months. However, yeah, so they're not showing a free cash flow payout ratio for the next 12 months. I'm not sure why, but they are showing the earnings payout ratio, which looks to be bumping up. I would want to understand what's going on with the earnings. Is that also going to then impact cash? Is it something that we need to be concerned about as a one-time deal? Maybe they're buying some heavy equipment or something like that, and it's a capital expenditure, which would reduce their free cash flow. But, that wouldn't reduce earnings. So I'm not really sure. I'm not really sure what's going on with that. Their shares outstanding are growing, and that might mean that they are growing. Sales are growing like crazy, so that's good. Return on invested capital, though, for me is pretty low, man. 4%. I bet that's probably maybe. I mean, let's say best case scenario, it probably is right on with their cost of capital. So if the cost of capital is 4%, the return on invested capital is 4%, it's probably a wash. So I'm not sure long term if that makes a lot of sense. Their debt's about 34%, so that's not bad. They got a pretty decent interest coverage. So I think SCHD Stan, I think I would want to do some more research on them. I would want to know what's going on in the next 12 months that's driving their earnings down. And then, what is that something that we should expect for the long term, or is that a one-time, issue? I just don't know. But if I were to invest in that, I would want to have those questions answered. So there you go. Those are my thoughts, my friend. STLA was for Steve, for you to look at, but I'll take the shout out. Oh, did I say Greg? I really didn't mean Steve, but hey, that's okay. I'll give you both the shout out, man. It's Greg and Steve's night tonight. So yeah, that's awesome. Thanks for that. Let's see. So this is good. I mean, I didn't read this whole thing, but anytime somebody says FYI, I learned something new today, those are the ones I want to read. Learn something new today. If you're collecting Social Security and have money left over, you can't get any tax break for adding money to your IRA. Who knew? Let me follow that. If you're collecting Social Security and have money left over, you can't get any tax break for adding money to your IRA. Okay. I'm not sure what the have money left over is. Let me know what that means, Jim. I'm not following that. I'm not getting Social Security right now, so it's not. I'm a little young for that, but that sounded mean, didn't it? I didn't mean it that way at all. It was just this came out, man. I didn't mean it that way, but anyway, I'm not following you on have money left over. So I'm sure it makes perfect sense to people who know a lot about Social Security, but I'm just not following it. Fast Eddie is in the house. Good to see you, my friend. El Dynamico says, looks like vodka. Well, I don't know, my friend. The vodka is clear, so that would be pretty clear. Yeah, Michael Swami says ATO is a great gas utility. I agree. Ex-Dividend Dad is in the house. Welcome, my friend. X to the what? X to the who? Ex-Dividend Dad. It's good to see you, buddy. All right, he's just got 2 cents, so he's going to give us his 2 cents, I think. That is a 4% pay raise, 4.02 to be exact. That must be on a stock. Maybe I'm in the middle of a conversation that's going on. Lots of things change if you're on Social Security, so I'm looking forward to it, but I'm not really looking forward to it because I'm sure the rules are crazy, man. So Michael says Lindy has foreign tax issues. That may be right. I didn't take a look at that, but I can check really fast. I mean, like Speedy Gonzalez fast, you know. Taxation. It's qualified 1099, so I don't think they U.S. investors will receive here. Let me show you, just so you don't think I'm lying to you. At tax time, U.S. investors will receive a 1099 form. So I think it's I don't think it's foreign. I don't see anywhere that says it's foreign. So I don't know. So Michael says, which is larger, a skosh, a pinch, or a touch? I don't know. I think all three of them are just a little bit. So I don't know. We should probably do some research on that. I think that might work. We can do some research. Okay, they got some tax discussion going on here, and it's a little over my head. So, Kevin Mendoza says, thank you, Kevin. Absolutely. My pleasure. Enjoy doing it. That's why we're here. That's why we're on the air live. And so Gant wants to know about STLD. Man, what is STLD? Let me see if I've heard of that. Steel Dynamics. Just do a real quick look here. Let me flip that on the screen. STLD's got a dividend safety score that's borderline safe at 54. It pays about 1.46%. It's in the steel industry, so that has probably a lot of cyclicality to it. Payout ratio looks fantastic though. It grows really fast at 18%. So that's a great thing. Let's take a look at the payout ratio really quick. Really low payout ratio. Return on invested capital looks fine. Yeah, I don't see any issues with it. But I bet it's pretty cyclical because it'll run with the price of steel. But yeah, I mean, if that's okay, if that's what you're looking for, I think there's nothing wrong with that company. So that I can tell. Thoughts on owning water? This is from John J. I like drinking water, so let me take a drink. So water, stock ETF like American Water, AWK, or WTRG. So I think water is fine. The last I looked, I used to own, I think it was AWR, American Water Works, or something like that, and made some money on it. But they were just, in my opinion, at that time, way overvalued. I don't know if that's changed. So what was it? AWR maybe? American States Water. That's what I owned. And let me show you what I'm looking at. Let me share this screen with you guys. So this is, I'll take that off. This is Fast Graphs. And if you take a look at this, I mean, this water is trading at a 24.78 PE ratio. That's pretty high. Let me put the blue line on here. Let's see. There we go. That's where it normally trades. So it is, it's below where it normally trades. So that's a good thing. Let's take a look. Let me narrow this down to the last 10 years. So yeah, it's down a bit. I don't see any issues owning water. But again, they are very much like the utility groups. They get paid on their investment. So, I know a lot of people want to buy water because it's like a precious resource, and it is. I just don't know if that's a reason to buy water. If you like the company and and it fits well in your portfolio, I don't see any issues with it. I think they're fine. All right, let's see. Where were we? Ex-Dividend Dad says he just learned. Oops. Here, there we go. He just learned a new word today, skosh. So, hey, you never know what you're going to learn, man. This is like a plethora of words that are used on this show. So, does he mean you can't invest it in your IRA because it's not considered income? Fast Eddie, does he mean you can't invest it in your IRA? I'm not sure I'm following what that is. I'm not sure. Maybe it's part of a different conversation. John J says, Lindy operates as an industrial gas company in the Americas, Europe, and yeah, that is true. Greg says, so we got another word here. It's called smidgen. So we got a skosh, smidgen, touch, pinch. So, yeah, we'll have to define all these terms. So what is that called? Where you spend a lot of time working out details on things that don't really matter. Honeybee says that Lindy is in the UK, and that's interesting. So, but I do believe that there is an agreement between the U.S. and the U.K. and that no foreign tax is held out for UK companies. I think that's right. I'm not sure what this means, so I'm kind of scared to put it on there. Smidgen is a quarter shock. Quarter shock. 1/3 Canadian shock. I have no idea what any of this means. I don't know, Jim. Who had to bail because they had the runs? I didn't see that. But we should know who that is. And if it's you, don't be embarrassed, because we would love to have some fun with you on that. So, no, I didn't know that. All right, let's see. My 4% pay raise comment was in relation to the dividend hike for MO. Yeah, no, I think that's right. Yeah, 4% raise roughly is a good thing to have. I mean, it's better than a sharp stick in the eye. Keeps pace. I'm thinking way ahead of actually what I'm saying. So it keeps pace with inflation, and for something that has a yield that high, that's really what you want. So the only question with Altria Group, and this is, I think everybody knows this, is what's its long-term potential. It's really hard to be in a business that the government wants to shut down. So that's kind of hard. Michael says AWK is American Water Works. AWR is American States Water. AWR has been better in my opinion. And yeah, that's the one I owned at one time, was American States Water. So yeah, that's good. And he says, and of course he owns AWK. Let's see here. All right. So we one other thing I wanted to help point out today is what's coming up this week. What should we be looking at? So what I thought I would do is show you guys I'm going to take Michael's comment off of here. This is the economic calendar that's inside Tip Ranks. If you guys are interested in Tip Ranks, there is a link in the comments. I think it's a 50% off if you use the link in my comments below this video. So if you're interested in Tip Ranks, there's a 50% off deal in the notes to this video. But here's one of the things that it'll show is what's coming up. So if we wanted to know, hey, what earnings are coming up this week, we can come in here and say, okay, Tuesday looks like we've got CCL, which is Carnival Cruise Lines, and FedEx plus 11 more. So you can see down here in the details who they all are. See CCL, FedEx. Those are probably the two. I mean, I don't know if anybody owns Barnes & Noble anymore, but maybe there's somebody on here that does. So that's coming up tomorrow. On Wednesday, one interesting one that I think it's going to be worth looking at, worth at least paying attention to, is General Mills, GIS. So pay attention to what's going on there in the food industry. What kind of they're having to give prices back, because they're having to compete more. Or are they able to hold prices level? Maybe some of the costs are coming back down. Not really sure. But it'll be interesting to see what's going on with General Mills. That maybe, even if you don't own it, it might be worth paying attention to. I don't see anything else on Wednesday that's exciting. Thursday, we got a couple that are exciting. One is Nike. So if you're interested in Nike, it's going to report out after close, it looks like, on Thursday. And Walgreens Boots Alliance. It'll be interesting to see if they've got any change of strategy. I know they've changed out some of their leadership team. So that's going to be before the market opens. And then if you own McCormick and Company, which is the spice company, that'll also report out before market opens on Thursday. So you have those things. And then also we have the economic calendar. And we can select the impact of 3. Those are the things that are like really impactful. So any. And so this week on Thursday, we have the durable goods orders and the gross domestic product. It's going to be put out at 7:30 a.m. on Thursday. I think these are Eastern time. Then on Friday, you're going to get the core PCE. That is what the Fed looks at. It's one of their key metrics for figuring out what to do with the interest rate, as well as personal income, personal spending. And then on Monday, we have the business confidence next week. So we have that going on. So those are the big things that are happening in the market this week. And I will hide this now. Let's see what else we got here to talk about. So Jim was just going to correct them. It's not the runs, it's the Hershey squirts, because we like to talk about Hershey as a dividend stock. So great point, my friend. What will we do without you? I mean, this is humor. You can't get this in just any channel. Yeah, it might have been Ryan's or Russ's. I just don't recall anybody having the runs and needing to leave. So, all right, let's see. SCHD goes ex-dividend on Wednesday. So that's good. SCHD Stan, I think you own quite a bit of SCHD. And they did, I think they did very well today. Let's take a look at that real quick. Let me find... we'll just use tip ranks. SCHD. Yeah, they went at 1.4%. That's fantastic. So my portfolio overall went up 0.29%. Here, let me share this. And so, and this is, I use tip ranks to track my portfolio. So if I look at the overall portfolio, 0.29% for the day. So that's not too bad, right? $4,400. I'll take that any day of the week and every day of the year if that happens. But take a look at the dividend income. Now, remember, my dividend income account is my after-tax account. It is what I use to generate dividends for me to actually use. So you see that went up 1.44%. So great day for my income account. But overall, I only went up 0.29%. So there you go. So yeah, that's right. Great job. So I think we're going to get a nice increase. My prediction, so this is SCHD's Stan's prediction, is 77.65, which is a 16% over last quarter Q2. That would be tremendous, man. That's a nice increase. So let's remember this. I'm gonna not sure how to do this, but let's come back to this when we see what that is. So 16% I'll remember. So SCHD Stan, 16% is your take on that. Let's see how they do. So that would be awesome. All right, guys. Well, we are 58 minutes into the program. There's stuff down in the notes of this video that there's links to Seeking Alpha and tip ranks, and I don't know what else down there. So, but if you're not a member of the Discord, my Discord channel, we'd love to have you in that. We talk about stuff like this all the time, and so love to have you there. If you're into Discord, just look us up, man. It's free to join, and we'd love to have you in there. So with that, I think I'm going to go ahead and shut down early and get some more of this water in me, because it was so hot and dry cutting that pasture. It was awful. So with that, let me say one more thing. I don't know, I probably had all of you drop off because I said I was signing out, but I'm going to be putting out a video later this week, and it's going to be a video about the book that I finished on margin of safety. And I learned so much from that book. I want to share that with you guys in a video. It'll be an edited video. So look for that later this week. I have recorded it. I just haven't edited it yet. And Michael says to be sure and hit the like button. So with that, guys, I'm going to sign off. It was a pleasure. I love being on here with you guys. And next week, I'll be at the beach. I'm going to take my equipment with me. If I can work it out, I'll do a live stream. If not, it'll be the week after. So with that, I'll talk to you on the next one.